Okay, folks, so we got a lot to talk about today, and it is going to be quite violent. First, we got to talk about the market and plays, including ChargePoint's earnings and a new Trump-style DWAC hype stock. And then I want to talk about one specific short squeeze setup that is heating up very, very interestingly. One may even say detonating, especially if they look at my titles. And I want to give my opinion on it as well as projections moving forward. Is this going to keep running? Is this going to dip massively and then run again? We'll talk about it and my reasoning behind my thought process. And the only thing that I ask in return for all of this is that you hit that ravishing like button, and also don't forget to subscribe either. Also, prices on ZipTrader will go up this Friday for the first time since launch, so if you do want to lock in lifetime access for the one-time fee, make sure to go ahead and check it out below. Okay, Marquetta, another nice green day, getting very, very close to all-time highs. Dow, S&P, NASDAQ, Rollskis, very solid week so far. ChargePoint released earnings. They jumped from 56.1 million in revenue to 65 million quarter over quarter. We have nearly doubled our sales of charging station hardware, and quarterly revenue as a whole increased 79% year over year. The growth rate overall is very substantial. You pair the two recent quarters, you have a steady jump in network charging system hardware, aka the charging stations, from 40.8 million in revenue to 47.5 million, a subscription jump from 12 million to 13.3 million, and other revenue sources increased $1 million. Now, in terms of cost of revenue, of course, subscription services, aka software, very cheap to maintain, are the best because you could sell more software subscriptions and really not have that much more overhead. Software is a lot more scalable, whereas with hardware, you're always going to have some sort of cost to actually build the hardware and then resell it. But overall, in terms of a trajectory for a growth company, this is a very, very healthy report. They also raised full year guidance to 235 million to 240 million. Back in October when I did our breakdown of EV charging stations, I was projecting 2021 revenue at 231 million, so full year guidance being raised to 235 to 240 million is a welcome sight, beating my expectations. But anyways, good earnings in my view, but market analysts haven't been super happy, and neither has the stock price. ChargePoint boosts revenue guidance, but a wider loss sinks the stock. Ugh, EV charging stations, why would you want to buy that? They're just big money losers. Sell and go buy steamboat companies. Those are safer bets. The article went on to talk about how they reported a fiscal third quarter loss wider than a year earlier. But context is key. Why do you think they have third quarter losses wider than a year earlier? Well, because in order to lock in twice as many hardware clients, which they did, they had to spend twice as much in many areas. It's very costly to get people to adapt to the hardware, but once you start reaching scale, you have all these people that now have your hardware, and they're also paying subscription fees, which is software and a lot cheaper to get to people and a lot more reoccurring. It's kind of like when you buy a printer companies don't make much money on the printer, they make the money on the ink because they know, hey, you got to get that ink from somewhere, and it's going to be them because of the way that they set up the system. But Charlie, doesn't the increased revenue from more sales offset the losses? No, and the reason is because you have to spend a lot more money on R&D, on marketing, and on overall product launches in order to actually convert people. Back in 2020, you didn't have ChargePoint trying to do that because we're in a completely different environment now. Back then, people were still worried, oh no, we can't invest in anything because of pandemic. Now they're like, okay, well, EVs are going full-fledged. Let's go ahead and throw money at everything EV and develop some damn charging stations. And thus, ChargePoint is trying to seize on that demand now, and that's why you're seeing so much more spending in every single category to get more and more customers, and it's working really, really well for them. The fact that its revenue is up 79% and their net loss is up 70% isn't a coincidence. It's because they're scaling their efforts into this broadening market. And in order to actually scale, they have to invest. And in order to invest massively during an early growth stage, they're going to have wider losses. If they didn't scale up their expenses, what would the media be saying? Oh, ChargePoint's failing to seize on market. And by the way, a lot of these efforts are actually becoming a lot more efficient right now. If you actually compare this quarter to last quarter, net loss has actually steadily trended down from 85 million last quarter to 69 million this quarter. So really, quarter over quarter, ChargePoint is investing more and more money at getting more and more clients and customers that actually go and use their subscription services and pay up front for their hardware. And at the same time, now they're starting to manage costs more. So yeah, year over year, wider than expected. But when you look at the trajectory, we're doing very well. Oppenheimer analysts, who I believe have been very, very fair to ChargePoint, gave their opinion on earnings. They said, we believe core to our bullish thesis is the growth of high margin reoccurring revenue and view this quarter's results as a positive indicator for ChargePoint's growing customer base and footprint. Given U.S. policy and funding set to support calendar year 2022 and 2023 revenue growth, we believe progress in this segment is an important lever for capturing outsized share of that public funding. So not only do they see this quarter as proof of concept for ChargePoint, but they see it scaling up and performing in the niche as a indicator that, hey, wait a second, when this federal funding starts coming out and getting rolled out after this plan is passed, well, ChargePoint may end up being a huge benefactor of it. Another stock that I want to bring to your attention that we've been talking about a lot of the ZipTrader U briefings is CFVI. So back at the start of the month, CFVI announced that they were in talks to take public Rumble, which is a competitor to YouTube, and is said to be a more neutral video platform. In their announcement, they say that Rumble was built on the belief that all creators should have the opportunity to freely express themselves and reach their followers without censorship or restrictions. They say they create technologies that are immune to cancel culture. Obviously, in light of many prominent folks getting banned on various social media platforms, there's been rising demand for this sort of thing, especially from American conservatives, and apparently it's been pretty popular. The CEO said Rumble is the most exciting social media and video distribution platform in the market today, with 36 million average monthly active users in Q3 of 2021, including 44 million monthly active users in August 2021. It is clear that Rumble is the new market for innovators, creators, and consumers. I'm excited to support Rumble and its ability to operate the neutral video platform. Obviously, some salesmanship there, but in terms of real data, viewer engagement grew 44x from Q2 of 2020 to Q3 of 2021. They also reportedly are in talks of a distribution deal with Trump, which of course is something that adds to the potential for CFVI to be another DWAC-style hype runner, on top of its already DWAC characteristics. And you already know that when I talk about pre-merger plays, I tend to view them as catalyst plays regardless of what they're merging with. And the reason is because SPAC merger details can change quite a lot before they actually go through. And post-merger stocks tend to trade like they would post-IPO anyways, which is to say they sell off from a lot of the euphoria and attention that they're getting. But pre-merger, there does tend to be a lot of hype cycles, and the closer you can get them to their SPAC floor, which in this case is about $10, although sometimes it does trade slightly under it, the better odds you have of getting a de-risked fun hype play. And considering that the whole SPAC process is very, very long-winded, and considering the amount of capital that's willing to pour into political hype stocks at any point, I think that CFVI is going to have a lot more fun periods before the actual merger goes through. And it's also sparked a lot of interest in political hype stocks overall, which is another reason that we've been talking about DWAC again on the briefings, and that one also has seen more attention. But remember, at the end of the day, hype doesn't last forever, and cool-offs are always brutal after hype periods. So you want to make sure that you're trading them with a clear plan, and you're not somebody that's just going and buying and holding and hoping for it to go back up if you bought in at all-time highs and then it crashed. With that type of strategy, you're better off just buying a high conviction play that you're planning on buying and holding until it hits a price target that you value the stock or company at. With these, you're trading off catalyst-driven momentum. After the merger, you can make an argument for a conviction play if this is your type of stock, but right now, I would argue you're still in that too early to say stage. Okay, finally, Pioneer Power. So back on the morning of November 8th, we gave our bull and bear setup ticker on PPSI in the briefing, and it ran quite a lot on that day. This was during the whole EV euphoria period, so a lot of these stocks were running, so you had a lot of those positive tailwinds working for us. And on the channel that night, we broke down how we discovered the PPSI hype setup because of its launching of their eBoost suite, which provides off-grid mobile charging solutions for EVs. This would be especially helpful for like EV trucks who travel long distances and don't want to have to worry about having to go and stop at charging stations and charge up all the way before they go to the next destination. Of course, by nature, there's not that many electric trucks right now that are going across the country, but the hype potential is still there nonetheless, and that's shown to be true based on the reaction. A lot of what they offer honestly would be very, very helpful, just not at this stage of EV development. But anyways, I saw the news combined with the fact that EV and EV-related stocks were in a hype phase, and the low float nature of the stock, and that's what made me originally brief on it as a strong setup, and it did perform well that day, helped by the overall inflows. And high plays come and go, but yesterday it reappeared on our radar as a different type of play. In yesterday's briefing, I cited PPSI as being an interesting play based on high short interest, high cost of borrow, and new media coverage from a lot of main outlets like, for example, Benzinga, who said, hey, this is a big short squeeze setup, which creates the self-fulfilling prophecy where you bring in a lot of retail attention to the fact that it's a short squeeze setup, and it makes it even more so a short squeeze setup. And I was like a day early. It ended up running only $1 or so yesterday, but today it ran up to just under $12 before selling off again, which always reminds us why we need to keep following a lot of these setups, regardless of whether it's running on the day that we think it's going to run. But the question is, number one, what can we learn from this? And number two, is this going to run again? Well, what we can learn from this is, number one, if you want to find a hype stock, you have to find, number one, a hype setup. Number two, a lot of retail traders following it. And number three, ideally, something like a short squeeze catalyst or some other catalyst that people can anticipate and cause more buying pressure that continuously goes in and incentivizes people to keep the stock relevant. And I would argue that PPSI has all three of those characteristics still going for it. So it's still relevant. And in terms of whether this is going to continue to run, we have to look at the history. In early 2020, we had a slow and steady rise that gave way to the first squeeze rally. Then it sold off. Then it gave a second attempt, and then it sold off again. Then gave a final and third attempt, and then it sold off. Now, one could say, well, wait, Charlie, this time around, we are once again on the third attempt. If this pattern repeats, doesn't that mean that we're going to go into another sell-off that just bludgeons the price? Well, maybe. But remember the context of this last drop. This dropped because the entire market went into risk-off mode for 3 weeks and tanked everything related to growth and especially EVs. Electric vehicles all of a sudden weren't an emerging industry anymore because, oh my God, inflation. But this time around, interestingly enough, PPSI, which is a very risk-on play, has managed to survive the back and forth fear spikes the last couple of weeks and retain attention despite all of this, oh no, the variant, oh no, interest rate spiking concerns, oh no, tapering. So I'd argue while still a very spec play and a trade, definitely not a high conviction play, something that you hold and hope with, but rather something that you trade off the momentum with, well, I would argue that ever since PPSI broke out over our red directional SMA line back here, it's held and rejected every single attempt to hold it below said trend, which, given the high level of short interest and current retail attention, I'd argue that the next dip to said trend line would be met with a lot of buying pressure. You may end up getting enough firepower that actually gets you up to a new all-time high. So what am I saying? Well, I'm just reading the chart, but if you're looking at the chart right now and you're considering the momentum setup, a lot of the eyes that are watching this right now, and the previous history, I think that you're in the situation where if you did get a nice sell-off that bounced off that trend line and you saw that buying pressure, all of a sudden, I would say that the argument for this doing another breakout attempt would be very, very, very strong. Is this a speculative trade that would be tanked in a very, very risk-off period? If we get another risk-off sell-off on Friday with the CPI index, would this tank? I think so. But based on how it performed the last few times, I would argue that it might have some staying power. And especially if you're going to play it, I would say at least make it show some proof of concept, but also keep in mind the overall trend. And of course, manage your risk. Anyways, that's my thought on this stock. At the end of the day, speculative trade, but something interesting to keep in mind if this is your game. Anyways, that caps off the video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you're looking to join us at ZipTrader U for lifetime access to our step-by-step lessons, our private chat, our daily morning briefings, as well as our price targets, well, I'll go ahead and put the link to that below. Prices for ZipTrader U will go up this week, and of course, our coupon code is still active, so now's a good opportunity to check it out if you haven't already. If you're wondering what broker to trade these stocks on, well, we like to send new traders over to Webull, and we'll put a link to Webull down below as well. You'll get 2 free stocks when you sign up and deposit with our link below. Have a good one, and I'll see you in the next video.